Live streaming is on.
All right. Good afternoon, everybody. Event Trader here. We are live and ready to kick off the Sentiment and Flow show. A quick look at the market still before we get started. We are slipping to 50.42 here in the S&P. The lows of the session, of course, at 50.37. So first, we'll talk a little bit about the backdrop of the markets intraday here. And to do that, we will, of course, bring in Brett Manning, chart trader, to get his read on things. So, Brett, how's life treating you these days?
I'm not sure because I'm not sure we're live. So
Let's see if we are live.
I can't launch Trader Audio. I do not see the little dials moving.
Okay.
Nothing
No, we're live.
We are. You sure? Okay,
We're live. We're good to go.
Access is somehow not working.
Yes,
all right.
sir.
Well, hey, doing well then. You sure about that? Then I'm good.
I am sure about that. The only thing I got to get corrected here is to get our screenplay. And there we go. We should. Oh
yeah. Now I see it. All right. Good.
All right, Brett. So within our dilly-dallying there, we got a little bit closer to the session lows. So I know you were looking a lot starting yesterday afternoon at the VIX and that pop, or the put call ratio, I should say, and that pop up to 1.3, obviously showing an extreme. You felt that could lead to a push early on in the morning. It was a very nice call by you as we did dip down to 50.50 at the initial onset of the opening there. We were able to squeeze all the way up to 50.96. I know I tried taking a short right around 50.75, expecting to see a little bit of resistance there. Now we rolled up to 50.96. It was very similar to that spike that we saw, which again you called out very nicely. I think it was on Tuesday with that particular price action there. Got that spike, got up to about 50.96, and since that time frame, we are down just nearly 60 points. So be curious as to your take on the intraday price action. We'll obviously get into the broader market and what's happened over the last week or two, but just today and the last couple of days, kind of what you're seeing out there.
Well, I mean, and for one thing, by the way, you should also mention we are 2 handles away from 5,000 on the SPX cash.
Right.
So we are right kind of to the most obvious level you could look at. But yeah, I think the look, we've been really, really bullish going back to, I think, mid-October of last year. And really actually going back to February of last year. There's kind of 2 waves to this so far. I think the basis for that was a really extraordinary situation, especially in October, of malpositioning and imbalance in the market that wrapped itself up nicely with a huge rally that we've seen since basically November 1st, I think, right? That was the Fed day in November. And everything's just launched and been in a really steady upward trend. We spiked, and then we saw all these breadth thrusts, and which have a really, really good historical record of kind of predicting follow through. And then we had this trend channel that was very, very nicely laid out in the major indices that took us up to really just a couple weeks ago, pretty much in a straight line. And I think the overall theme now is, things got a little ahead of schedule. And this is a timely corrective phase, and the market really needed to take a breather. And there's been a few different things that have sort of conspired to give us the opportunity to correct in what had been sort of an impossible to short market for months, with geopolitics, with the breakout in interest rates, and now this week with the Fed pivot. And I think it really is a Fed pivot in terms of the language. But we still have a lot of longer term measures that point to the fact that this is all happening in the context of a continuing larger bull cycle. And we'll talk about some of that. And in terms of understanding how to position inside of this correction, I think we're looking for signs. We want to see the old standard is really how quickly do people immediately turn bearish? Like, are we going to see a couple more down days and suddenly, the end of the world is near? Or are we in a different framework now than we've been in for the last couple of years, where, it takes a little more work to rebalance those sort of sentiments and positioning measures. And obviously, the market doesn't exist in a vacuum, and there are issues that need to resolve in a manner that's conducive to the continuation of the cycle. So, there's a lot of headline risk that's still sitting out there, and I think that those are the main themes.
Yeah, and these are all themes that we're going to be breaking down as we go across some of these charts and some of the slides that we'll be talking about. So let's dig into that. Market trying to find a little bit of support down around these lows here, Brett. We'll keep an eye out on it. If I see anything of note, I'll definitely break in and highlight that. And Brett, obviously, same on your end if you're seeing anything of great note. So
Absolutely.
as Brett was saying, first sentiment and flow show in a couple of months. So, we're going to be doing a little bit of catch up. But as Brett was pointing out, we were pretty bullish going into the year, really all since last October, and it turned out to be even prior to that October. But it turned out to be right. Now we are hitting a bit of an inflection point. So some of the data that we're going to be looking at is going to be pretty intriguing, and really looking forward to hearing Brett's thoughts on it as well. But first, the market characteristics, right? So buy the dip now has turned into a bit more sell the rip, but again, for how long? The S&P, it's down about 4% from its all-time highs, a little bit over that now, approaching that garden variety 5% correction level there. I think, Brett, over the last 10 years, I thought I saw that every correction's been at least 6% for that matter. So just something to kind of keep an eye out on.
Right.
That does take you in the S&P futures contracts right down to that 5,000 psych level that you were talking about for the cash, as well as the 20 weekly moving average, which is at 50,006 for the record. Coming into earnings, there's obviously a higher bar for earnings. We've certainly seen that with a lot of the initial reactions to some of the banks. VIX, that's been percolating over the last couple of weeks there with a lot of the geopolitical backdrop that we'll talk about. When you're rolling correlation between equities and fixed income right now, that ranks in the top 95 percentile since 2000, which, obviously makes a tough proposition for the 60-40 portfolios and for rebalancing there. Just noted the geopolitical minefield that's running around. And then, of course, the higher rates with the 10-year hitting those 2024 highs. So, Brett, just kind of encapsulating all these market characteristics, what's kind of popping out to you as the primary driver right over the last few weeks?
Well, I mean, I think we're going to talk about the excessive positioning theme to some extent, right? And people getting a little bit too revved up and creating a vulnerability. And so there's an imbalance, and it needs to go back to a state of rebalance. And then there's just circumstances that have conspired to allow for a window of that. And I think, the rates are important, but I think we've acclimated somewhat to rates in this neighborhood. So I don't know how much shock is going on there. It's not the same thing as rates at this level 6 months ago, because that was shocking to see. And now we've been between 4 and 5% for half a year, and the economy's still rolling along and ripping. So I think that there's a little bit of we've sort of become anesthetized to the idea of 4.6%, and probably when we get to 5%, it's not going to be the same experience that we had when we were 5% the last time. And I think this sort of open question of how Israel is going to respond to Iran, and it's just kind of sitting there, and it's an unresolved uncertainty. It makes it tough for people to really step in with conviction, and I think that's making it easier for bears to really hammer the bid. I think we're seeing some of that. Like, there's an opportunity in the unresolved uncertainty of that headline flow to come in and really start to hammer at things. And I think that's maybe more important than a lot of people are giving credit to. It's just an opportunity. It's just an undefended market right now.
Yeah, and we'll do some game theory in a second on Israel and Iran. But to your point, Brett, I wanted to ask your thoughts. Obviously, we got a pullback going on. There's been a lot of people sitting around looking to buy, not necessarily buy the dip, but awaiting a pullback to get in a little bit more favorable level there. So in your experience, how do you see this playing out? Obviously, again, a headline minefield, as you've been highlighting in the last couple of weeks. So what are some of the characteristics that you would suggest that the headline minefield is kind of past us and we got more opportunities for those buyers to step in? Because right now you got to figure, if you're waiting, you still feel like you could be a little patient.
Yeah, well, that's exactly my point. That's what I mean by an undefended tape. Like, and if you're a bear and you know that there's excessive speculative positioning in the market, which there certainly is, like that doesn't, every bull market has it. That doesn't mean it's a top. So when we talk about that sort of point, like every time you get rolling in a bear market, the stock market is asymmetric. It's not the same in each direction. If you look at a currency market, it's more symmetric. If you look at a commodity market, it's more symmetric. In terms of there's about the same number of bears as bulls. There's about the same number of shorts and longs in currencies and commodities. But when you look at the stock market, it's more like a 90-10 kind of split. So when you get a bull market that's rolling along, you're always going to have, the periods of greatest momentum are going to pick up a lot of speculative interest. There's going to be a lot of fast money. There's going to be a lot of vulnerability, but it's not necessarily a cycle contrarian indicator. You got to get way further into something like we saw, at some of the most major tops we've ever seen, where it's a collection of very long-term imbalances that add up to something just extraordinarily imbalanced. But in just a standard historical bull market trend, it lives, when it gets going, it lives in a state of imbalance and speculative positioning. And there's always these opportunities. And and people who are good at shorting, especially in things like, the futures market, and they've got deep pockets and they've got big accounts that, when you get some uncertainty, some unresolved situation, and the institutions aren't going to step in and dig their heels in and have a basket sitting there at a level and support the market because we haven't resolved the situation yet. They're going to wait for that resolution. As a bear that you can hammer that tape. Like you can come in and hammer it. There's going to be a lot of small players, fast money players, not as deep pockets who are going to be, put out of the market on a risk level. I mean, you just got to get it through a threshold and everybody's going to puke it out. And there's a big bucket of money there for you when you do that. And when you get this kind of headline uncertainty, it's coming off of a situation where some of the charts we're going to talk about, where there's an allocation situation that's gotten to, multi-month or multi-year extremes on certain levels, that vulnerability is there to be able to hammer it out and get your bucket of money. And we're seeing that.
All right, let's break into the Iran-Israel conflict. Obviously, this is decades in the making. Really feels like it's kind of bubbling to the surface now in terms of
Centuries.
actual direct, centuries, millennials in the making, right? But so as we get deeper into it, where we stand right now is everybody on pins and needles on whether or not Israel's going to strike back. So just watching the UN headlines here, where Iran was saying that they had no choice but to attack Israel after it attacked its consulate, and that it doesn't seek war. Of course, a lot of people would push back that Israel had no choice, considering the proxies that continue to attack it. So you get Israel on the other side now talking about how they have no choice but to respond. And I was actually watching the Guns of August documentary last night, Brett, which is based off of Barbara Tuchman's phenomenal book on the August of 1914, when World War I got in and both sides kind of were trapped into this. We have no choice but to respond. So what do you think Israel is eyeing up? I mean, for me, I think the most obvious is an attack on the nuclear facilities. It gives them an open and go in there. What do you see in terms of game theory of how things are going to unfold from here between the two countries?
I mean, if you look at it like you're looking at it, like this basically gives Israel an opportunity to shrug and say, well, we had to do it. And then they can make some move that is strategically meaningful over a very long time frame. Then that would, I would agree with what you're saying. Some kind of infrastructure that sets Iran back from being a nuclear power on some level would be the obvious way to take advantage of this sort of, I mean, this just becomes an opportunity, like a freebie, especially since Iran has been very clear that they don't want this to turn into a war, and Iran really made a strategic mistake. I mean, they did it, it was really just I think just an open strategic mistake to do a performative retaliation where they more or less signaled, I mean, as I understand it, they sent a lot of munitions in a way that was very easy to defend against, almost intentionally.
Yes.
And to try to say, look, we're not actually trying to kill anybody. We're not even trying to destroy any of your infrastructure. We just want our people to see that we're doing something about what you did so that we can remain viable as a regime.
Yeah, I likened it to professional wrestling.
Yeah, right. There was the jump off the ropes with landing with your hands and knees rather than landing.
Yeah, exactly.
Yeah. Right. And but the problem with that is it just opens up the possibility that Israel can now say we're justified in doing something more. And if Israel can use that, if they have a plan that makes it viable for them to go in and destroy some infrastructure that sets Iran back from becoming a nuclear power significantly, then, how can they not try to take advantage of that?
Yeah, and that's how I kind of see it too. I mean, I think that's the low-hanging fruit, an attack on a nuclear facility, and it would be tough for the U.S.
I mean, as long as it meaningfully changes the course for Iran. If it doesn't, then it's not a good idea. But it needs to meaningfully set Iran back. And maybe that's possible. Maybe it's not. I don't know. You don't know. Nobody knows. But maybe Israel knows because they're the ones with the most intelligence on the situation.
Yeah, well, it will be interesting. I've seen speculation too. I know timing has come in. Passover, I believe, is April 22nd to April 30th. A lot of talk about maybe something happening after that, but I think the market wants a quick response, and I feel like there's a psychological aspect to Israel's waiting, right? I mean, rather than just saying, this is part of the issue when, and you saw Iran do it similar to Israel, where, people being on pins and needles expecting an attack can sometimes be just as brutal as the attack itself.
Distress,
and it certainly feels that
absolutely.
way. Yeah. So, and unfortunately for the markets, keeps us in the waiting game. I guess the obvious question for you, Brett, is how do you see this impacting the oil sector?
Well, so far we're seeing it. Like, you have to go with what the market's showing you, and right. So far the market is extremely complacently accepting the idea that day-to-day supplies into the market are not going to be meaningfully affected by this.
Yeah, I mean, it seems to me the biggest impact would be Iranian oil primarily is going to China right now, right? So I'd be curious to see how.
Well, it's all fungible though, right? China will just be buying from somewhere else. So if Iranian oil is taken off the market, the oil price will spike.
Right, exactly, and that was going to be my point. China's going to have to get it from somewhere, right? So, that'd be an additional inflation headline for the Fed to deal with.
Well, and the EU, who doesn't separate out energy.
Yeah, and the EU in particular, right? And just keeping an eye out on crude here. It's basically flat on the day following yesterday's pullback. All right, moving forward, AAII data today, Brett, obviously ticking on the bearish side. November 2nd across the board in terms of lowest for the bulls, highest for the bears, and the largest bull bear spread, or the smallest, I should say, as that was down to 4.3. It was minus 26, I think, the week of November 2nd. So what's your thoughts on the latest AAII data here?
I mean, it's obviously interesting that it has stayed in the zone that it has through this process. I guess that's the first point. But let me shift to your. Hold on 1 second. I'm having a technical issue of my own. All right. So I mean, so first of all, and as we've said before, the AAII data tends to be a contrarian signal in a pullback, much more so than in a rally. So, in other words, you can see
stay elevated for longer on the bullish side.
Well, it tends to actually more than that. It's almost a positive signal. Like historically, when we've seen rallies take off, where the AAII gets to be, 50% bulls early on in the rally, those rallies tend to extend further. But when you get pullback where the AAII data gets to, you get 20 to 25% bulls for 4 or 5 weeks, like that tends to be a very good buy signal. So on the bearish side, getting bearish AAII data tends to be a buy signal, but on the bullish side, getting bullish AAII data tends to not be a shorting signal, generally speaking. However, there's a caveat to that, which is by that same logic, if you extrapolate it out in a pullback, we want to see the AAII data quickly crater, like we did, 7 or 8 times over the past year and a half. We've noted it. So you want to see that situation. If you want to be a buyer, when there is a correction going on, you want to see like it's sitting at 47% bulls, during the rally, and then there's a little bit of a correction. Immediately it goes to 22% bulls. Like that is your signal for buying. That sort of dynamic shows you that you're still in the type of market where every pullback you want to pile into. So right now, to see April 17th, which really reflects, back to April 8th to 15th or so in that zone in terms of what people are experiencing when they're answering this question. Still, it next week will be important. I guess that's my theme here. Next week's data will be important for AAII. We want to see this at 28 or something on the bull side. To be thinking in terms of buying the 5,000 level. But again, there's this open issue when the Israel headlines hit. But go ahead.
Yeah, I would just say one thing, but the one thing that I was seeing interested, the last time we saw a decline this steep would have been mid-August.
You mean in the market or in the
AAII data? Which is when we started rolling over there. So do you have any concerns about?
You mean steep? What steep?
In terms of a drop from the bullishness to bearishness,
but it's still above the long-term average bulls.
Yes. Yeah. Right. Okay.
Right.
No, that's fair.
It's like it's still there. Like it didn't drop into a zone where we are, historically showing people being more bearish than usual.
Yeah. No, that's a good differentiator for sure.
So we want to see that next week if we're bullish. Like if you want to buy the market at 5,000, you want to see next week there's like a plummet. But I mean, this is one indicator. It's one simple thing. That's not at all a trading system basis that I just described. But either way,
right.
Like what we've seen repeatedly over the last year and a half, where Gavin and I have been saying, buy every dip, it is because we've seen that. As one of the things that we've seen is that. Every time there's a little bit of pullback, people go immediately to the end of the world, right? We've talked about this before. It's weird, but it's bullish.
Everything's a great financial
That's your signal to buy the market. It's a great time to be buying every dip when you feel like everybody suddenly goes right to, oh my God, the sky is falling every time there's a single down day. And we're not seeing that quite as much in this particular pullback. So there's maybe a little bit more of an extended process.
All right. And then just the last piece on the AAII. Just throwing this one out at you. They ask their weekly special question and, interpretation. I was curious to get your thoughts on this.
It's so tough to interpret this one.
Right.
Yeah.
Do you think other investors are too bullish or bearish right now? 50% said they are too bullish. Yet when we look at the AAII data, it doesn't suggest that they're as bullish as they have been, right? Then 27% thought their sentiment towards the market is about right. 14% thought that they're too bearish. 8% no opinion at all. I thought it was I was really just kind of curious to hear your interpretation of this, Brett, just because you always have a pretty good take on survey questions and what they represent.
I mean, this is it's like one of those statements where you're trying to figure out what a statement means when it's got like 6 different negatives in it, like instead of just a double negative. I didn't not go to the not store. Like it's so tough to kind of weave yourself through this when you think about how people are thinking and then how it impacts the market. If you look at just like neutral plus bearish is greater than 50% of the survey. So you could find that 50% that says this in there, but still historically there's more than average. There's a greater than average number of bulls in the market. But surely there can't be anybody who answered this question who's bullish. There can't be anybody who says people are too bullish who answered I'm bullish, right? I mean, that's a tough one to
Yeah.
get your head around. So you're talking about almost everybody who's neutral and bearish being. So maybe what this says is the intensity. And maybe it's that coefficient that I talk about. So maybe that's what we're getting to, is if every single person who's neutral or bearish says everybody else is too bullish, then maybe there's more intensity in the opinion on the bear side than there is on the bull side. There's more of a depth of feeling to it. Just saying you're bullish versus bearish is one data point. But if you have a coefficient that says how convinced are you of that answer?
Right.
Maybe the people who are bearish feel more strongly about it than the people who are bullish. Maybe that's what this shows. I don't know, but I'm just speculating.
Okay. All right. Moving along here. We are going to start taking a look at the Bank of America Fund Manager Survey. This came out 2 days ago. Some of the highlights from it: most bullish since January 2022.
First of all, before you go, let me just say there's
Yes,
this survey. I feel like this the fund manager survey, the way that this document is produced, I feel like there's an editor at the end who's a little bit too obsessed with trying to come up with clickbait versions of things.
Yeah.
And so like it's the most in 27 months, or it's the most.
It does feel like that's the opening line for half these things, doesn't it?
But like every single data point is, and if you really look into it, it's not nearly as dramatic as it's being. Like they're coming up with I think they want the media to pick up these statements. So
Yeah.
and you pretty much copy them verbatim here, and you'll see there's a lot of these things that sound very dramatic. But I want to do a couple examples of this for people. Like if you look at it in context, it's not a remarkable thing at all. But it's an attempt to get Bloomberg or CNBC or something to pick up the headline and put it out there, and it's important to kind of point that out.
Yeah, and we're going to go through, and I'll just read through these, and then we'll go through the context just to kind of back up your story and dispel some of the sensationalism and
Yes.
the opening commentary. But biggest jump in global optimism since May 2020, record jump in allocation in commodities. That's, factual, right? There's no real way of sensationalizing that. FMS cash drops to 4.2%. First time since December 2021 that investors say global growth is expected to accelerate. 76% expect 2 or more Fed rate cuts, which, we talked CME Fed funds futures, nothing too surprising there. We had the largest drop in bond allocation since July 2023, the biggest 3-month drop in cash since August 2020, and gold most overvalued since August 2020 as well. So we're going to go through and take a look.
How do you know gold is overvalued?
I was just going off the commentary, but yeah, I suppose in terms of, well,
it doesn't have a PE ratio.
It's just in terms of a yes/no question. Do you think gold's overvalued?
I know. I know.
But yeah, no, I agree.
People think gold is the most overvalued since, but all right.
Yeah, so people think gold is the most overvalued since August 2020. Of course, everybody's still buying it, so they can't think that it's that overvalued, I suppose. But just kind of working through this equity allocation at 27-month highs. Then
there's the tricky one.
Yeah, and then we did see a big rotation into materials, energy, industrials in Europe, which goes to the breadth thrusts that Brett was talking about from the past couple of months. So taking a look at it, we're going to hit right off with the equity allocation, Brett. We are taking a look at this. You can see April 2024, definitely on the march, but you can see there's plenty of other instances where
this is the beginning of a cycle, is what it looks like.
Right. I mean, if we were to cut out this piece, you could probably cut out that 2020 going into 2022 piece. I mean, a lot of the start of these big ramp ups that you could see, this looks like the initial phase. Call it the first 3 innings. Look
at the damage to equity allocation in this last bear market. It's comparable to the Great Recession.
Yeah.
In terms of how fund managers were behaving. And what we saw was nothing like that at all. So the market was much more resilient against this massive outflow and underweighting of professional money.
And that's
now
pretty much
all started to come back in.
And that's pretty much all rate related, right, Brett? Because I mean that it's
I
not
don't know what
during
it's
COVID.
related to. It's what we're talking about. Everybody thinks the end of the world's always right around the corner. I don't know, but
Yeah.
people reacted. I mean,
Well,
extraordinarily
if you're just looking
bearish.
at the time frame, it goes right around August of 2022, right? So I mean, that kind of pulls into when CPI really started to spike.
Yeah, when the Fed said it's not transitory. Second they said that, everybody went, "I'm out of here."
Yeah. And but we're, like you said, just simply recovering from that. Now, there were a
Yeah,
few episodes of drops right after the great financial crisis, of
right.
course.
But as a case in point, like this headline was put in the fund manager survey as what was it? The
Highest in 27 months.
the equity allocation at a 27-month high. Like that's something to try to get somebody to pick up that headline as some extreme of market behavior, right? 27 months is a long time. This is when people are but here it is on a chart. Here's what it
Yeah.
looks like in the context of history. This is not an extreme in terms of the behavior of fund managers in relative to equity allocation. So I'm just
Yeah.
saying we got to be a little bit, suspicious on
In
the way that the bullet
context.
points are listed in this survey.
Yeah, and as we say, rising, but not at extreme levels by any stretch, especially looking at other, and this is going back a quarter of a century nearly at this point. So,
Right.
CTA positioning. This is a little raises a little bit more of a red flag, I would say. Because as we know, Brett, one of the primary reasons why you were so bullish was because of how low this CTA positioning was, and you can kind of
Yeah.
see it
Look at
back
that October of
back.
last year. Look at
Yeah,
that thing.
exactly. Down
It's
in the
crazy.
minus 50 percentile. It has since
Yes.
flipped to the high of 60. So, and that line there, that's basically the 95th percentile
Yeah.
for positioning over going back to 2019. So just about 5 years of action here. So, do you see this as part of the fast money that's moving just because CTA positioning is a little bit more on the hedge side, so trying to catch lows and everything, so therefore this is kind of the money that's getting shaken out here?
To some, or it's flipping around and hammering the bid right now because it's got an opportunity to do so. Like it's shifted already. We saw a CTA sell signal last week that this chart doesn't reflect probably. These guys are going to move on the trend changes fast, and they're going to go until it works and until it stops working. And yeah, I think that we've traversed. I think the bigger thing is just look. You can see right here we've traversed the entirety of the imbalance from last fall in terms of really systematic trading futures participants with as a group certainly sway over the market. So we've gone all the way back after there was this absurdly disproportional level of bearishness that we hit in September and October of last year that just really still is dumbfounding to me. But that sprint back the other way certainly is why we saw such a dramatic rally. This is part of it. There's a lot of other groups of participants in the market that really, this is probably just a good plot of the psychology and the psychological adventure that most market participants have had over the last 6 to 8 months. And we've traversed all the way back at this point. This is that plot. So now we're back to normal and we've got an opportunity to, rebalance things a bit and flash back into the body of this move. And that's what corrections are for.
Yeah, and as we could see, there have been higher levels in this. So, as Brett said, for my money, this is a lot of the fringe money that's getting bounced around, which is one of the reasons why it's been so tough to short intraday and everything, just because you're going up against a lot of these CTA machines.
Yeah, well, it's very technically systematic, this money.
Yeah.
Yeah. So it's what the market does, what the market has recently done has triggered some kind of programmatic shift in how we're going to allocate.
Okay, moving along. This is from Goldman Sachs, gross and net leveraging from its book. Again, very, very high leveraging at the moment. Over the last year, the overall book on a gross 89 percentile for the 3 year at 96 percentile. So, it just kind of points to growing growing exposure on the long side here from a gross positioning. But again, not really seeing anything on the charts that would suggest that this is at a unreasonable level. I would like to see a chart that would have been provided that would have stretched back a couple more years rather than just going from 1 year ago. But it just kind of goes to show that if you're looking from a chart perspective, this hasn't spiked to an extreme. It's been pretty steady, is what I was looking at in this, Brett.
Yeah, well, and also I think that it pressed the threshold after we started to correct.
Yeah,
there's good reason to think that some of that is because a lot of people speculating on the short side.
yeah. No, I mean, I haven't seen the latest short data, but one would have to think that people were buying it. Certainly, you've seen an elevation in the
This
put
includes
call
bonds.
ratio.
This includes bonds. This includes
Yeah,
everything. So, I mean, it could be that a lot of this is really people shorting the crap out of the bond futures, and you
yeah.
haven't seen it show up yet in commitment of traders.
With that rally into the in
But with
rates, it wouldn't be a
the
surprise.
inflation change. I mean, we've had a kind of important shift in terms of the inflation picture, and that may have just been a green light for people to start. You remember where we were in short leverage in 10-year Treasury futures last year when we were coming over around 5%. Like, it was crazy. People were shorting it rampantly and openly and without any reserve. And it may be just like what we've seen over the last couple of months, and inflation data has left the door open for people to start to put that leverage back on.
Yeah. Keeping an eye on the markets here too. S&P has crawled back above that 50-50 level here. It's really just been chopping around for the most part since Brett and I started talking, but is pressing up towards the high end of the afternoon here. FMS cash levels, Brett, 4.2%. Definitely getting to the lower end. Now, Bank of America, they look at this as neutral for what it's worth. It's under 4% when they start getting the bearish signal there. So it's definitely a lot of money being put to work. But, I mean, it's not a complete surprise that people aren't in cash, considering you could get a good return from a T-bill. You could get a good return from a money market fund. So what's your read in on this 4.2% level in cash holdings?
No, I think you covered it perfectly. It is. I think that they're right. If you look at the very, very long term for this measure, this is your neutral territory. It's not giving a signal one way or the other. When you get to 5.4% plus, you've got a buy signal in the market. When you get to 3.7 or 3.8, you've got a sell signal in the market. And right now we're, in the low 4%, which is a very, very average positioning situation in terms of cash allocation among portfolio managers.
All right. Bullish sentiment in the FMS survey. We're obviously talking a lot about the AAII. Here's the BofA survey here, obviously on the rise. Been a steady rise there, but certainly not at extremes when you're looking at that bullish sentiment. And this kind of builds upon what you were saying, Brett, where the bullish sentiment in the AAII could really just build upon itself. And you see that play out here in this read, I think.
Yeah.
Anything else you wanted to add?
No, I mean, we were at a ridiculous place last fall, and we've kind of corrected that back into a more normal historical position.
And I would say with that rise too, it just kind of shows the easiness it is to shake some of the leaves off the trees, right? When you run in a parabolic level like that, this is why it's easy to get a 5% correction in a market that's been as strong as it has. I think when you're looking at this sentiment read,
especially when you got the cover of, any day now we're going to get a headline that Israel's just launched missiles into Iran or something.
Yeah.
At some point that's coming, and nobody's going to step in front of that with their heels dug in and their pockets open.
Yep. Here's the latest on the growth inflation numbers. Stagflation concerns are starting to come down. A lot of people are looking at a boom cycle on the rise here. So this just kind of lends to that strong economic data not necessarily being a terrible thing, right, Brett?
Yeah, I find this chart overall very interesting. Just it's about the next 12 months, but you couldn't have a better last 12 months. You know what I mean? It's such an interesting reaction. The inflation's on a year-over-year basis has just been sort of steadily declining, and we've had way above trend growth for 3 straight quarters, and like really ideal economic data during that time. I mean, almost in every way. It's been one of the most remarkably positive economic periods in decades for this country in every macro statistic for like 3 quarters now. And it's interesting that stagflation is still where it is as an assumption about the future. And during the entire time for those quarters, it's just been sitting there as like, this is about to become total stagflation, and we've had just booming growth. So it's interesting.
Unfortunately, booming debt, I suppose you could point to too, right? So, I mean,
what's that?
And booming debt, unfortunately, right? So that kind of
sure,
perhaps, I mean, takes some of the bloom off that rose. I would say.
Yeah, but we're talking real growth. The real growth is still there, and yeah. So the piper's got to get paid at some point is the idea,
right?
But still, it's interesting that people are sitting in the situation and still assuming that.
Well, I guess my point would be the growth's been booming, but so's the debt. It would be much more impressive if we had booming growth that was starting to erase some of that debt or improving our debt to GDP levels. Would be my point.
Right. No,
and that's not. It's not a. I'm not pointing in politics because we did the same thing under Trump when we were cutting rates with booming growth too. So I guess if you were to kind of point out some of the issues with the economic report, it's just the fact that this is coming with higher debt levels too.
It is coming with higher debt levels,
which leads to the question on it. So
yeah, I think there's more going on there, and it has nothing to do with politics. I just think like we're starting to see the front end of this technology shift.
Yeah. And AI definitely leading that boom, right? It's something that people have been talking about for years.
Productivity is going through the roof. There's no other way to explain it.
Yeah.
So like, yes, the that's there. But and this gets to another point, which we could talk about more if you want to. We don't have to, but I think the Fed policy shift and the way the Fed is handling things to me is a dead giveaway that 2% target is going away.
Gone. Yeah. Yeah, at some point they're going to start talking 3%.
I mean, this is how you handle debt, right? Like the greatest thing you could ever do to handle debt is have a society that's willing to bear higher inflation and not break down.
Yeah,
like that's a free ticket out.
And the productivity from AI, like you point out, definitely a key driver here.
Yeah.
Hard landing camp, Brett. That's been eroding, but so too has the soft landing, and really it's no landing, which kind of points to what you're talking about right now, just in terms of this is AI driven and everything. So definitely plays into that factor. This slide. Rate expectations here. It's at the 2% area. Do you even care about this prognostication, or are you kind of looking at it more from a standpoint, the more we hear from the Fed that no rates are coming, that could rattle the markets? How do you kind of look at this rate cut outlook, Brett?
Well, I mean, it was the best of times. It was the worst of times. I like your title.
Yeah.
Like,
oh yeah, exactly.
No, I mean, I think that this is where it's at, right? This is like this statistic is going to be, but how resilient everything is in the wake of a transformation away from. Like we came into the year, and one of the big bull arguments was, and I made the same argument, that the neutral rate was so far below where the Fed was, and like that adjustment doesn't necessarily need slower economic growth as long as inflation continues to correct, right? Like you've got this path here, like the ultra uber bullish situation coming into this year was this idea that the Fed may end up cutting rates into a booming economy because inflation's continuing to show this path lower. And you're going to have a really the Fed should be at 3% or whatever, and it's at 5+%, and it's going to try to get ahead of the curve and cut right into the boom. And so it shows you how important this shift in inflation data that we've seen over the last 3 months, and how important this week's adjustment to the language from Powell, and it was previewed by Daly, to come out and say we're changing what we see. We no longer want you to assume that we're going to be cutting anytime soon. And this is, this environment right now is different than we thought it would be a couple months ago. and that we're actually seeing stickier inflation than we thought. And that completely changes that bullish view, that argument, that specific argument. So it really comes down to like, let's see how resilient the market is to that shift, to understand how much substance is underneath the surface of this bull cycle. I think that's kind of an important signal. Like how really is this just about people thinking the Fed's going to be cutting into booming economic data versus maybe whatever the Fed does is fine. We don't care because we're looking at the longer term.
All right. There's services X food and energy. We've been talking about CPI. A little bit of an uptick back on this one following a long decline. This is part of that late innings piece there. Brett, you got any thoughts on this?
No, I mean, this is going to be something they're watching real close.
Yep. Tail risks, we get into this debate whether or not it is how great of an answer it is, but obviously you're seeing inflation really outpacing geopolitics right now. So I just kind of look at it as what could more likely impact headlines, get that most out of the headline. And we've certainly seen that with some of the gyrations around Fed speak this week.
Yeah, I think one of the interesting things in Powell's talk that was highlighted by Tim Arrayos in his Wall Street Journal article that followed up suspiciously like half an hour later, which is just ridiculous.
Yeah.
Like, obviously, this is a coordinated thing involved in the messaging. The Tim Arrayos highlighted, and obviously the Fed wanted him to highlight, that Powell was not in any way saying there would be any possibility of a rate hike. Right? Like It was, we're shifting our view around rate cuts and the rate of rate cuts and the timing of rate cuts and our view on inflation, but we are in no way saying we're looking at hiking rates, which I think is this other little tip toward, higher target level expectations. This is okay, 3 to 3.5% inflation, even though we're not going to say that officially. Clearly, that's what they're saying, and that's why we've seen gold and silver take off.
Yeah, so we'll keep an eye out on those. Earnings season underway here, Brett. Banks pretty strong out of the gate. Pretty much all the money centers beating on the top and bottom line. Guidance has definitely been a little bit more cautious language from the banks in particular. Also from Taiwan Semi last night, so seeing some of those elements. Overall, EPSN sales for this quarter are expected to grow about 3% year over year. However, the top 10 in the S&P, they're expected to see growth of 15% year over year, earnings per share growth 32% year over year. The other 490 sales growth of 2% and a drop in EPS. Utilities expected to be amongst the strongest year over year earnings growth. Energy and materials, a little bit of a laggard. And then the burning questions for this quarter: strength of the consumer, AI as a growth driver, and can mega caps carry the load? So, Brett, what's your early interpretation of earnings season, and what are some of the elements that you're looking for this year?
So I saw you and I talk about it, or I saw a note from you or something somewhere along the way that did another stat like this in terms of the top 10 in the S&P versus the other 490. It had to do with, I think, revenue expectations and earnings expectations, and this is a similar kind of framing. And it's really interesting, but these are expectations. And so the question is, are analysts way too bearish on the other 490?
Which is an element. And to be clear, on average, sales and earnings have come in 4% higher than consensus. This is going back 10 years. So, your typical undershooting game there too. There's that.
Of course, but I'm talking about relative between those two classes. Let's call it Class A is the, mega cap awesome things, and the rest of, and then there's Class B is the rest of everybody. So right now it's like earnings, everything's going to be amazing for the top 10. Everything's going to be crap for the other 490. And the question is that assumption off at this point? Because I would point out that in the last couple of months, the primary thing that I've seen in the market, besides the last week and a half, is a breadth expansion. A lot. Like we had a period a couple of weeks ago where we had like industry groups, like 90% of industry groups were at pretty much all-time highs. And we haven't seen that in a long, long, long time, like decades. So there's been a burst of expansion and expanding breadth, and people investing in lots of other areas of the market rather than just the Magnificent Seven So I wonder if that is discounting that actually, we're seeing an expansion in terms of how these companies are going to perform this particular earnings season, because that would make sense from a market standpoint. But analysts may just get into the groove of, where their projections lie is still kind of based on the recent past, where we haven't seen that breadth expansion. So I guess I'm really, the most interesting thing about earnings season this time around to me is when we get to the end of this earnings season and we look back on these stats comparing the top 10 versus the other 490, are we going to find that the ratio of assumptions there is just way off?
Yeah, so that'll be things that we are watching. For the record, too, haven't seen any issues on credit yet. It's certainly rising, but to a level that's still manageable. So,
And we had the best retail sales in 15 months?
Yeah. So, we'll continue to watch that play out. Of course, you are seeing the eroding savings and everything along those lines that get factored in here as well.
But anybody who wants a job can get one.
And just this was interesting because when you look at it, the 3% expected for this EPS growth, this would be the weakest quarter, Brett, since 2022, I think Q2 of 2022. Yet global profit expectations, that's the highest that we've seen in some time here. So, it's matching up with the return of the ISM manufacturing surveys as well. So, I do think that it puts a little bit of additional pressure on companies coming into this earnings season.
Yeah, could be. We'll see.
All right. Then just kind of bouncing around a few other charts here. Non-financial burdens. We've shown this here, just talking about that rise in interest rates, which is the concern. You can see this has been on the downslope, and I thought this was interesting too. This is from the St. Louis Fed. You can see that flatlining in terms of non-financial corporate burdens. This is corporate yield. So since those rates have risen, Brett, there's definitely been a pullback in issuance on corporate debt. People just not looking to borrow as much as high rates. So I guess the question is going to be is when does that cycle of really cheap bonds that they bought start to roll over, right?
Yeah, but also you look at this. I mean, look at the time frame of this chart. Like we've seen, there's been such an improvement in the business cycle.
Correct, which obviously helps in financing that burden. But I just thought it was notable that this is one of the things that people point to with those higher rates getting ready to decimate the economy. But when you kind of take it,
didn't we see just an incredible correlation in terms of refinancing corporate debt and the pandemic?
Oh yeah, everybody was rushing the paper out the door at that point.
We're in the wake, like
which again kind of shows you, the interest rate burden has been declining.
Yeah, regardless of what we've seen interest rates do. I mean, they fixed in those nothing rates.
I mean, you can see this was at 60% during the great financial crisis, and it's gone down below.
I mean, they did the obvious. They took the
cheap money.
Yeah,
but that cheap money will run out at some point.
At some point, exactly. So, there's the adjustment. At some point, when that runs out and everybody's got to refinance at 5%, it's going to be interesting to see what happens in the next.
Yeah, when they got to kick the habit.
Yeah.
Commodities, Brett. I know you've been very bullish on them. I do currently have a short out on the silver. This is just a quick intraday.
You got a what?
Play pullback. A short on silver.
You shorted silver?
Yeah, because if you saw one of the things that jumped out to me.
All right, that'll be interesting.
I did well, yeah, but you're long from a longer term perspective, right?
You just shorted today. You shorted silver today.
No, 2 days ago, and I'll tell you why.
Okay.
There's massive buying of calls in the silver sector,
right?
That doing a little digging looks like some covered calls, which would mean that anytime you see silver pop, people are going to be selling out from their position on it. So, I mean, it was to a point where it was just a head scratcher seeing what was going on there. So I just took the ZSL, which again, we're going on two totally different time frames. I think you're looking at a longer term swing. I know you've been long silver for about 3 weeks here. I'm just kind of playing this as one of the pullback areas, especially following some of the weaker China data that was out there. So,
Godspeed, buddy.
Yeah, exactly. But I mean, looking at this rally, though, we do see a pretty heavy allocation going on into the commodities. So you're of the mindset that this will continue to go higher, obviously.
Well, I think it's in line with the higher rates. It's in line with the sort of, if you have the Fed, look, if we're right by saying that the Fed is doing a de facto shift in its target rate, and we're not going to hear about it publicly maybe for years, but it's still maybe a de facto thing that's happening because, hey, like if society doesn't break down at 3.4% inflation, and we still, we've got this incredible run of employment, GDP growth, productivity growth, all these things are happening for the last year, the whole time, with inflation at roughly this level the whole time. That's kind of like, hey, it's go ahead, accept it if you're the Fed and Treasury. If you're talking about how we're going to handle our longer term debt servicing obligations, then the greatest thing in the world is happening to you right now. Like your money's just getting easier to get and to service things without any penalty at all. And it's just a free gift. Are you gonna try to shut that down? No. What you're gonna do is sit there and talk tough and not hike. And hey, the greatest thing that could happen to you is we just sit at 3.4% inflation and things keep moving along economically. But if that's happening, this is and other economies around the world are pretty much probably playing along and doing more or less the same thing. The cost of stuff, as who is that who used to say, Dennis something, the stuff that when you drop it on your foot, it hurts. Gartman. Gartman.
No, Buffett was the.
Buffett was the drop it on your foot.
Yeah.
It was Dennis Gartman. All right. Either way, that stuff all becomes more valuable, just ipso facto. So, yeah, I mean, I think that's what we're seeing in gold is just basically like you've got to reconcile with the market sniffing out, the inflation target for the Fed is now 3.4% or whatever. Yeah. And regardless of what they say, and that's going to increase the value of everything on that side.
All right, just moving along here. Commodities, another slide. Just again, overweight commodities here on the rise. The Bloomberg Commodity Index, the 6320, that has been on the decline though. So looking to watch this pull this higher, I would say. So just people moving into commodities for the very reasons Brett is talking about positioning. It's not at extremes though when you look at this compared to other areas. So more room for upside. But again, Brett, my silver short, that's just a short-term piece given what I was looking at, looked to be some pretty heavy buying on the covered calls in the SLV. Dollar valuation, will this have an impact on equities and commodities? This has obviously been on the rise, viewed as a potential headwind for markets. But you would think that if the Fed, again, to your point, Brett, changing how they view the longer term rate, this dollar valuation shouldn't be as much of a concern, right?
No, right? Because the dollar valuation is happening because of the fungibility in rates. So you've got a lot of money coming into the United States because, our rates have been moving higher and nobody doubts our ability to print money to pay stuff off. So there's going to be money flowing in, especially from Japan. A lot of it's been happening right there and it's pushing the dollar higher. But those things are the same things that are pushing commodities higher. So in this case, it's not an inverse correlation trade.
All right. Moving along here. Some of the seasonality that we've seen. Usually the first half of April is one of the stronger periods. It's all broken down into 2 weeks in the S&P. This is going back to 1950 on the returns. May first half tends to be a little bit weaker. But do you see this? Then you get a bounce in the second half of May is the usual tendencies. That's following a run up in April. So do you kind of think that some of the price action that we're seeing, Brett, could be a little bit of a pull through in the sell in May activity, given how strong the early part it is? Okay.
I don't buy that.
Do you have any thoughts on the seasonality here? Are you not over?
The only seasonality that I really believe in is the last week of October through the end of the year. The rest of it, and maybe the bias
when the money market fund.
There's a fourth quarter adjustment, and maybe it's linked to right before that the September late August through September propensity for crashes to collect in that area, which is preparing for fourth quarter adjustments. And then when you get past the early part of the fourth quarter and you head toward, holiday seasonality, and we saw it again last year, right? The same thing, exactly.
Yeah.
We said so many times that's when you get these people. There's a buildup of the offer's a little bigger, the offer's a little tougher. And if you have a lot of vulnerability, you can get a crash in that zone, but you're going to have a little bit more pressure there. And then when we get past that transition into the fourth quarter and we start to discount the holiday season, there tends to be a lot more upward pressure on the bid. And it's happened so many times before. But as far as the sell in May thing, I've never really, I've seen so many things, I guess, that violate that principle that it's tough for me to feel like I can count on it. Yeah. And I've run data on it, and it doesn't seem to add up.
Okay, fair enough. Then just quick recap on election returns. This is a slide from the last one, just kind of a refresher for people. Also looking at the rate cut cycle, which we've talked about in the past. Just on average, recessions have begun 12 months after the peak in the Fed funds rate. So, we still have a ways to go before we've hit that 12, or I guess not that long ago until we have the 12 months. This would go to July 23rd. So May 2024 would be the recession start date if you're going through the average. That's just going through only 5. So not a big sample size there, Brett. Just wanted to remind people on that. And the rate cut cycle, easing in monetary policy, typically begins before a recession starts. So again,
so everybody heard that, right? Gavin just guaranteed a recession starting next month.
It's starting next month, Brett.
It's along with his aliens blowing up the sun to stop the solar industry.
It's all coming together.
It's all coming together. You got it.
And then just a recap of the 2024 key themes. Fed rate cycle, we've talked about that in depth. The elections, still a lot of those to come. So, watching to see how that impacts geopolitical issues. Disinflation and the impact on earnings. For the year, U.S. forecasts 11% year-over-year growth. That remains in place. The first half of 2024 was expected to be some of the weaker forecasts. We saw Taiwan Semi reiterate that. So again, a lot of pressure going to be on the second half growth rate. Will credit rise? It has, but not to a point that it's unmanageable. U.S. versus the rest of the world. We talked about that. As per usual, everyone was talking about how the rest of the world was going to eat the U.S.'s lunch, but that's still not come to pass. Come to pass. Fed versus ECB. You're seeing the diversion going on there. Can China recover? That is continuing to trip itself up as their recovery is to just flood the rest of the world with exports rather than try to stimulate their own.
Exporting deflation.
Yeah, they are exporting deflation. I suppose.
Balancing out the equation.
Yeah. Unfortunately, it hasn't really hit to the U.S. yet, right?
Not yet.
Then balance of risk, inflation versus recession. We've certainly seen that the Fed views inflation as the much bigger threat. And then we talked about commodities being a hot play back in January, and that's come to fruition. So anything you wanted to add on these 2024 themes that we've seen play out here?
Not really. I think you've covered it succinctly. All
right. So let's go through, Brett. That's going to bring us to the end of the slideshow. Before we get into the close, one thing I just wanted to do a little pitch out there. I know Brett won't do it, but one of the reasons why we haven't had the Sentiment and Flow show is Brett's been very busy on a pretty important project with his wife called the Neurodiversity Edge. It's something that's close to my heart, having a nephew who's autistic. So, Brett, why don't you pitch your book real quick here, buddy?
Oh boy, I didn't know you were going to do this.
Yeah, well, because I knew you wouldn't do it, so that's why I'm kind of throwing you into the fire on it.
Well, my wife and I worked on this for a year and a half, and she's really done research. She's an Oxford trained PhD cognitive scientist, and she's been working on this for 20 years. And it is, I believe, the best book on the topic of neurodiversity in general, and on the problem of trying to help organizations come up with a way to find a path to valuing neurodivergent individuals, people with autism, ADHD, dyslexia, dyscalculia, dyspraxia, different neurological profiles, and to see that there's this balance where you have a really fixed kind of input process and a linear chained reasoning process for interviewing, for employee management, and you've got all these people who have a ton to contribute and who are kind of left on the sidelines and marginalized. Unemployment rate for people, for neurodivergent people, is like 30 to 40% versus 3.6% for the total population. And it doesn't have to be that way. And many of the great innovations we've seen over decades in society have been from neurodivergent people. And so she wrote a book about it. I helped her with the book. We researched it extensively and we put it out. And now it is actually a national bestseller. And we're really proud of that. And it's getting a lot of traction. But, we put so much into it. If this is something close to your heart, please support it. It's called The Neurodiversity Edge. The audiobook just came out a couple days ago, Gav. Yeah. It's on audible.com. We were so happy with the narrator. She was incredible. So the narration is really, really good if you're into audiobooks. But a portion of the proceeds from every sale go to charities that are related to this topic. And we put our heart and souls into it, and we think it's a really important book, and it's caught on, and we're very thankful for that.
All right. So if anybody's got any questions on that, you could certainly hit Brett directly. Feel free to write in a feedback. We'd be happy to help you get your hands on a copy. I've got one myself. I've broken into it, and it's definitely a really good read. Anybody who might have, this is Autism Awareness Month. Anybody that has a friend or a child that has autism, and it's a growing number. That's being reported as such. This would be a good book for those people that are wondering what the future may lie for these particular people, because they do have a lot to offer.
Exactly.
So, all right, Brett, I did want to get that in for you. Like I said, I knew you wouldn't do it, but since it is Autism Awareness Month, I felt that, and it would help explain our absence on the show for the last few months.
It's been a big task to get this out and going.
Yeah, and a worthwhile task too. So, all right, Brett, let's do a quick recap. You always do a much more eloquent version of this. So, what is the current market dynamics for you, and what are you seeing out there that we need to be watching in the coming weeks?
I think it's about the questions that you ask yourself when you're trying to figure out what's next. And the questions I ask myself in a correction, especially when there's the technical picture, and then there's underneath the surface of the technical picture, which I think should be basically almost our slogan for this show. Like, what is underneath the surface of the technical picture? What is it? Where's the strength and the intensity? Where's the positioning? Where's the opinion? Where's the expectations? Which shift? You could have the exact same chart and have two very different scenarios there, and it tells you a lot about what to expect. And so we try to kind of unearth what's underneath the surface of this picture. This picture is very obvious. Technically, it's a really strong bull market and an upward trend with a small pullback that's happened so far. We are still well above the 200-day moving average, miles above it. It's still pointed straight up. We've recently broken out to new highs after a large sentiment downturn style correction, bear market last year or the year before, that saw us get to depths that were almost as bearish as what we saw in the Great Recession, even though it was really a relatively minor bear market overall, which that disproportionality is important. Usually that's a bullish thing. And now we've got basically the breakout of sort of a cup with handle formation on a weekly chart in the S&P, and we're seeing a small pullback right now. And so the question is, did we get to such intensity, such overwhelming participation on a sort of multi-decade level that we so far overshot that we're heading into a much less favorable macro context and earnings context, and everybody's malpositioned, and now finally we've seen a major top and we're starting to pull back into the abyss? Or are we seeing a more sort of garden variety pullback in a persistent and continuing upward cycle? And I think the way to differentiate those two, one of the important things is, how quickly do people become bearish? How quickly do they become overhedged? That's a signal about the opportunity. Obviously, if they become more bearish faster, if they become more overhedged faster, you should be more bullish. If it lags, it doesn't necessarily mean we're heading into a bear. It could just mean that we're going to be in a sort of a range and a choppy period for a bit. But the positioning matters, and what we've covered today, I think, is consistent with the idea that there's some headlines that have allowed there to be enough vulnerability for aggressive bears to kind of get involved and start to knock out vulnerable bulls and vulnerable bull money out. And there's certainly been plenty of it coming into the market, so there's plenty of low-hanging fruit to take out. A point early on that Gavin made that I think is important is you look at how this impacts the sort of 60-40 model. When you see rates moving up while stocks move down, that means bonds and stocks are moving down together. That means that having diversification between stocks and bonds is not a hedge. And typically we should see that result in a higher cash allocation. And right now we've got a multi-year low in cash in portfolios, which means that probably there's a lot of people out there who are going to be raising cash, which should kind of keep there being a little bit of resistance on the offer on bounces, because they've got to do that work. It doesn't necessarily mean the market's going to plunge lower. It just means, it's not going to be probably not going to be a slingshot pattern. Tomorrow we're just going to be back on the way to the highs in a straight line. Probably more likely that this is going to have to settle a bit until we work through that process. We have the turnover that we need to get. But we've got a lot of headlines in the way, so making predictions like that is difficult because the Israel thing could be wrapped up by tomorrow and earnings could be just incredible, for the rest of the earnings season, or the opposite of that scenario. So the market doesn't exist in a vacuum, and we're going to have to kind of keep charting those events.
All right, Brett, as per usual, always a pleasure talking to you. We'll let you get back to the desk on your end there. We should be getting back into the cycle of running this on the monthly. We always try for the third Thursday of the month. That's usually when we get the fund manager survey, which as you know, we like using as a companion along with this discussion. But Brett, thanks for all the information and feedback. And we're just going to be shutting down audio here temporarily. And I'll be back on, and we got Netflix coming up here after the hour.
One thing I want to do, a couple questions about it. So just the title of the book again, I see some feedbacks. It's The Neurodiversity Edge. If you just search that, you will find it.
And I am putting the name of that in the on the pages here. So you will see that when I post the replay. The name of the book will be on that. And any questions you have and feedback, feel free to write in a feedback, or you can contact Brett directly on it too.
Awesome.
All right, Brett. We'll talk to you in a bit then.
Okay. Hey, take care, Gav. Thank you.
You too.